Well, hey there. Let's dive right into this. When you open up your investment portfolio, what's the first thing you look at? Probably just numbers going up and down, right? You're checking those basic financial returns. But I want you to pause for a second and consider what's really lying beneath those investments, way beyond those surface-level percentages.
Literally, what lies beneath your investments? It's a huge question because, let's be honest, those traditional numbers, they only tell about half the story. In the massively complex world of asset management, there are all these hidden operational and societal risks and opportunities that can literally make or break a fund over the long haul. We're talking about the deep mechanics that usually stay firmly behind closed doors.
So to uncover those hidden mechanics, we turn to the SASB standards. Think of these standards as the ultimate nutritional label for the asset management and custody industry. Basically, they're industry-specific sustainability accounting standards, and their whole job is to measure the non-financial risks and opportunities that eventually hit a company's cash flows and cost of capital. They show us the actual essential ingredients for long-term stability.
Okay, so here's our roadmap for this explainer. We're going to unpack the 5 essential pillars identified by SASB. First, transparent information and fair advice. Second, employee diversity and inclusion. Third, incorporating ESG factors. Fourth, tracking financed emissions. And finally, number 5, upholding business ethics.
Let's get into Pillar 1, transparent information and fair advice.
Now, this first pillar, it is all about customer-facing risks. Asset managers have a strict legal obligation to align their interests with your specific risk-return profile. On one hand, you want licensed employees providing fair advice, totally transparent fees, and suitable products. Simple enough, right? But on the flip side, failing to do that leads straight to massive monetary losses from legal proceedings, incredibly costly litigation, and worst of all, destroyed trust. Things like mis-selling products, hiding fees, or bearing insane risks in the fine print, that doesn't just hurt the client. It fundamentally damages the entire asset management firm.
So how do we actually track that? Well, the SASB standard says firms must track some very specific metrics. We're talking about the official record of investment-related investigations, any consumer-initiated complaints, and private civil litigations tied directly to their licensed employees and decision-makers. They also have to clearly detail their exact approach to informing customers about products, especially when it comes to complex or high-yield risks. By tracking the exact number and percentage of decision-makers with a regulatory record, the industry can actually head off costly market manipulation and protect everybody, from everyday retail folks to huge institutional clients.
Moving right along to Pillar 2, employee diversity and inclusion.
Financial markets are, frankly, incredibly complex, and the competition for top-tier skilled talent is absolutely fierce. To keep track of this, SASB actually requires entities to systematically tabulate gender representation, women, men, and not disclosed, across very specific management levels. They have to break the whole thing down for executive management, non-executive management, professionals, and literally all other employees. It's not just some vague, nice-sounding corporate commitment. It is hard, systematic data reporting. They also track diversity group representation to make sure historically underrepresented populations are quantified across those exact same tiers.
Now you might be wondering, why does an investor care about this level of tracking? Well, because expanding candidate pools shrinks hiring costs and massively improves operational efficiency. But even more importantly, industry evidence actually suggests that diverse employee groups can enhance the risk-return characteristics of investment portfolios. Think about it. In an era dominated by algorithmic trading and lightning-fast innovation, having a genuinely diverse range of skilled perspectives isn't just some social goal, it's an absolutely crucial operational metric if you want to stay competitive.
Okay, on to Pillar 3, incorporating environmental, social, and governance factors.
So this pillar really gets at the core fiduciary duty to incorporate all material information into decision-making. If an asset manager ignores non-financial forms of capital, they are risking diminished returns, lost market share, and a massive outflow of assets. To prevent that, managers use specific strategies to bake ESG directly into their assets under management, or AUM. This includes the systematic integration of material ESG issues, sustainability-themed investing, like clean energy or sustainable agriculture, and various forms of screening. That could be negative, exclusionary screening, or positive, best-in-class selection.
And the actual process of making these ESG investments happens in concrete steps. Step 1. Managers incorporate these factors right into their fundamental valuation and modeling. Next up is portfolio construction, where they actually adjust the time horizon and risk-return profiles based on all this new data. And finally, it involves active ownership through proxy voting and investee engagement. They use this non-financial data to sit down with company boards, vote on environmental and social proposals, and systematically generate superior long-term returns. It's super hands-on.
Which brings us to Pillar 4, tracking financed emissions.
Look, financing borrowers or counterparties with high greenhouse gas emissions creates absolutely massive credit, market, and reputational risks for an asset manager, especially as the whole world transitions to new climate policies and green tech. So to gauge this exposure, managers have to cleanly separate and measure their absolute gross financed emissions across 3 distinct categories. Scope 1 covers direct emissions. Scope 2 covers indirect emissions from purchased energy, and Scope 3? That covers all other indirect emissions hiding in the value chain. By disaggregating these scopes, a manager gets a crystal clear look at their actual exposure to carbon taxes, shifting policies, and rapid technological changes.
And to truly grasp the massive scale of these risks, the standard requires reporting a very specific, very important number: the total amount of assets under management included in that financed emissions disclosure. They also have to report this as a percentage of their total AUM. If an asset manager has billions upon billions of dollars officially tied to high-emission assets, they are incredibly susceptible to regulatory shifts. It's a direct flashing indicator of whether they need to adapt their investment strategies before it's too late.
Finally, we reach Pillar 5, upholding business ethics.
This pillar literally underpins the entire financial industry by demanding strict regulatory compliance through incredibly robust internal controls. The standard sums it up perfectly right here. Entities that ensure regulatory compliance through robust internal controls may build trust with clients, increase revenue, and protect shareholder value by minimizing losses. Asset managers operate in this hugely complex international environment. They're fiduciaries, they're custodians, so tracking monetary losses from fraud, insider trading, antitrust behavior, or malpractice is absolutely essential. And maintaining strong whistleblower policies with real incentives and independent hotlines is exactly how you prevent catastrophic market failures.
So when we take a step back, measuring these 5 pillars creates a totally comprehensive nutritional label for asset management. It perfectly synthesizes transparent information, employee diversity, ESG integration, emissions tracking, and strict business ethics. Brought together, these metrics give us a transparent look at the operational health of a firm, and that protects both the everyday retail investor and the long-term stability of the broader financial system.
Which really just leaves us with this final thought. As the management of non-financial capital increasingly dictates actual market value, can an asset manager who ignores these 5 pillars truly fulfill their fiduciary duty in the 21st century? Thank you so much for joining me on this explainer, and I highly encourage you to go take a closer look at the hidden mechanics of your own investments.